Emira shareholders have a reason to smile. The group has upped its interim dividend by nearly 9%. On the downside, higher than average vacancy rates and rental reversions are weighing on the company. Interim revenue is down nearly 3%. Operating profit fell over 10%, while headline earnings per share plunged by almost 29%. Michael Avery caught up with company CEO Jeff Jennett and kicked off the conversation with a look at the group's exit from Australia and investment into US retail. He asked the CEO what the relative attraction was for this particular move. Here's that conversation.
It has been a very tough 2 years. It's been extraordinary circumstances, and we're fortunate that we've come through. The retail environment, though, is a very strong one. It's bricks and mortar isn't going anywhere. And I'll also just sort of share with you some of our experiences that we've seen in the United States, where we've got 14 and a bit % of our total assets. Is that there's already, we can see it already becoming a hybrid model in terms of how online and physical retail actually interact. And so that stores actually become delivery points. And I don't think that the South African market in terms of South African retail is going to get to that stage, because our system is just different in terms of the way the Americans work. But we're going to learn a bit from that. And I do think that, there has to be that entertainment, that experiential, that feeling of excitement when you get to a shopping center. And it's got to be easy and convenient. And then it's got to blend in with online so that you can do your pre-shopping before you actually arrive there, and then you know what you're going in for.
And you exited Australia and invested in US retail. What was it about the US retail market that has really excited you? And what have you learned about making an entry into a market as big as the US when it comes to consumers? No one likes to shop more than the US.
Yeah. So for us, our exit out of Australia was on the basis that the valuations that we were seeing just didn't justify our anticipated growth prospects. We managed to find a subsector in the US economy, being a grocer-anchored, dominant power center of value-orientated retail. In other words, focusing on open air and value-orientated shops. And we saw this opportunity where the bigger, larger REITs were looking to sell out, and the yields that we could acquire just, and you compare that to replacement or new build costs, just didn't justify. So we managed to get in on a meaningful discounts to what we saw new builds would be. The yields were excellent, and we could get in. But there is a key to getting into the world's biggest market, the United States. And that is, don't try and go and do that by yourself. So we were fortunate to find a partner that puts up $1.05 for every dollar that we put in as well, so that we would co-invest with the right team that enabled us to then, certainly in the times of the pandemic, they could deal with what was actually happening on the ground. There was American dealing with American, rather than trying to do it from a totally remote basis. So if you're going to go into a different jurisdiction, you must have the right team on the ground, and they must co-invest with you so that their motives, their targets, their performance, their behavior is driven in the direction that we as a South African REIT, as a shareholder, want to see as well.
Property is very much a local game. You need to understand the local context and the operating environment. And at the recent SA REIT Association conference, there was a sense of frustration around the slow growth South African economy. You can't control that. That's out of your and management team's hands. What are you focusing on at the moment to try and ensure that the sector bounces back, that you bounce back, and we start to see a reduction in these discounts to NAVs that already have ballooned through the pandemic?
Yeah. So, Michael, to me, there are two things. One is that you need to continue to invest into your buildings, as Emira has done over the last 7-8 years, on a continual basis, making sure that that real estate, in my words, is as great as it can be. And if the buildings are great, well, then you have a better than even chance of attracting the right tenants. That's the first thing. The second thing is that you have to be flexible, you have to be adaptive, you have to be innovative with your letting strategies to arrive at a situation where it works for the tenant, the new tenant, or the existing tenant, and it also works for you as the landlord. So you've got to sit down, you've got to be flexible, and only through that will you then be in a position where, as you can see, our vacancies have improved down to just the 6.1. that you can continue to let and you can continue to receive rental income and then ultimately pay out dividends to shareholders.
And in terms of that rental reversion vacancy picture, what is starting to emerge through the portfolio?
So offices are still under pressure, and I think will remain so for the next probably 12, 24 months. Retail and industrial, both on the vacancy side, those have improved. And really, I mean, the vacancy on the industrial side, vacancy, we're back to pre-COVID levels. The offices, the vacancies have picked up, but that rate of vacancy is increasing vacancy has definitely slowed and is probably starting to plateau. On the reversion side, we've been calling this for a long time, that unless you get meaningful economic growth, you're always going to have rental reversions. So we're still sitting with high teens in terms of rental reversions, and we don't see that changing. Why? Because you're still signing leases with 6 to 7% escalations, and economic growth means that market rentals will only increase by 1% or 2 or 3 every year.
That was Jeff Jennett, CEO of Emira Property Fund. Sticking with results, a resurgence in travel has boosted short-term